Welcome to Drill Down Earnings. We have quarterly results from Amazon, second quarter results from this company, and they were good, better than expectations, but the stock's selling off. Why? Well, Wall Street likes a beat or a miss. I should say Wall Street likes a beat. Short sellers like a miss, usually. This was a beat, but the stock's selling off. So let's dig a little bit deeper and talk about what we saw in the quarter from Amazon. So growth was up, although the growth rate slowing a little bit, but 10% growth on a year-over-year basis. Their AWS business growing at 19% year-over-year to $26.3 billion. Fantastic growth in AWS in a really big business here. And they've been able to cut costs in that business as well. When we look a little bit deeper, what we see is, profitability from Amazon. 9% profit margins. This is a business that was famously unprofitable for the longest time, generated cash flow as it continued to pay its bills slower than it got paid itself, which let them grow this business, but now showing consistent profits. And yes, a lot of that AWS growth re-accelerating has been good for this business, of course, because most of their profits come from AWS. 2/3 of the operating profits of this business now come from AWS. Now, importantly, it used to be more than 100%. They used to lose money in everything they sold in their retail business and make up for it with AWS. Well, now you've got AWS with 64% of the profits from this company. So maybe a disappointment in these numbers among concerns about future spending, and we're going to get to that, was their advertising business. This business is huge, $13 billion in the quarter for advertising from Amazon. We don't think of Amazon perhaps as an advertising business. It certainly is. But only 20% growth, slowing growth in this business. It's been really fantastic and consistently growing for them. Yes, still growing on a year-over-year basis, but only 20%. Maybe that's a concern. After the numbers came out, the stock sold off right away, down 8%, continued to sell off as the conference call went on, and the company reiterated its focus on spending to build out data centers. But overall, the stock's up 40% this year with an 8% sell-off in after-hours trading. But Andy Jassy, the CEO of Amazon, talked a lot about how their customers are thinking about data centers and how they're thinking about moving more and more of their business to AWS, which they think is just the right thing. It talks about this kind of pandemic journey, I think that a lot of us can relate to, about how they were addressing things before the pandemic, how they were addressing things during the pandemic, and now they're getting back to thinking about their businesses in a different way than they have in the interim. Here's Andy Jassy.
Pre-pandemic, we were on this march where most companies are trying to figure out how to modernize their infrastructure, which really means moving from on-premises to the cloud, because they can save money and invent more quickly and get better developer productivity. And then the pandemic happened and people were in survival mode, and then a difficult economy came and people were trying to save money. And we just see people going back to asking themselves, why aren't we taking this low-hanging fruit here? I mean, it makes, I don't want to run my own data centers. I can actually be more cost effective and invent more quickly for my customers if I'm using the cloud. And AWS, with just a lot more functionality, stronger operational performance and security, which really matters to customers as well, and a deeper partner ecosystem, continues to be the partner of choice as people are moving to the cloud. And I think the generative AI component is in its very early days. It's as I said, we kind of sometimes look at it and say it's interesting that we have a multi-billion-dollar revenue run rate already in AI, and it's so early. But if we look at the amount of demand that we have from customers right now, it's very significant.
All right, what's this mean? Well, here's your Drill Down Earnings takeaway with one number that tells us a whole lot right after this.
The Drill Down is brought to you by Futurum Group, where analysts, researchers, advisors, content creators, and marketing experts help business leaders anticipate and understand shifts in their industries and build strategies to leverage disruptive innovation. With deep analysis, Futurum Group's extensive industry experience delivers reliable research and data, thought leadership, and actionable advice to help you with your strategy and go-to-market efforts. Futurum Group.
So Amazon just reporting second quarter earnings. Well, those better than Wall Street expected. The stock's selling off. I'm going to explain why. So you saw a 10% growth in revenues on a year-over-year basis. Profitable revenues at that, strong profits from this company, and a turnaround in the growth rate of Amazon Web Services, now at 19% on a year-over-year basis. So what could possibly be wrong? Well, they're spending a lot more money in building out data centers. They've made a financial commitment to graphical processor units and AI spending, and that's a lot of money. Wall Street's concerned. One last thing. The non-AWS business is also catching up to the AWS business growth. AWS growing at 19%, the rest of the business 18%. Not too bad for Amazon.com. But thanks for checking out Drill Down Earnings. I'm Cory Johnson. And you can check me out on X at Cory TV. You can check me out on Drill Down Pod on Instagram and TikTok and all this other great stuff at the 6.5 Media channel on YouTube, which you're probably watching right now. Leave us a comment or subscribe. Tell us what you think. Drill Down Earnings, part of 6.5 Media.